Welcome back to Muscular Brain, Fat Wallet, where we help you build wealth and financial success through smart investing strategies. In today's episode, we're tackling a question many investors wrestle with: should you choose value investing or growth investing? These two approaches dominate the investment landscape, and each offers unique advantages depending on your financial goals, risk tolerance, and time horizon. So, if you've ever wondered which investing style suits you best, stick around. By the end of this video, you'll have a clearer understanding of value and growth investing, their risks and rewards, and how you can use these strategies to achieve your financial goals. What is value investing? Let's start with value investing, a strategy made famous by legendary investors like Warren Buffett and Benjamin Graham. Value investors look for stocks they believe are undervalued by the market. These are companies whose stock prices don't accurately reflect their true worth, often because of temporary challenges, market fluctuations, or negative sentiment. The core principles of value investing. 1. Intrinsic value. Value investors are focused on determining a stock's intrinsic value, or its actual worth, based on fundamentals like earnings, revenue, and future cash flows. 1. The goal is to buy stocks when they are trading below this intrinsic value. 2. Margin of safety. One of the cornerstones of value investing is the margin of safety, meaning investors look for stocks that are significantly undervalued so that even if their intrinsic value estimates are wrong, they have a cushion to minimize losses. 3. Long-term focus. Value investing is a long-term strategy. 3. Investors buy stocks with the expectation that the market will eventually recognize their true value, but this could take years. 4. Financial discipline. Value investors use rigorous financial analysis to assess the health of a company. 4. They look at metrics like the price-to-earnings ratio, P/E, price-to-book ratio, P/B, and free cash flow. What is growth investing? On the flip side, we have growth investing, where the focus is on companies expected to grow at an above-average rate compared to the rest of the market. Growth investors are less concerned about the current stock price or whether the company is undervalued, they care more about the company's potential to expand rapidly. The core principles of growth investing. 1. Earnings growth. Growth investors are looking for companies with strong earnings growth. 1. These companies often reinvest profits back into the business to fuel future expansion, rather than paying dividends. 2. High valuations. Growth stocks typically trade at higher price-to-earnings ratios, P/E, because investors are willing to pay a premium for their potential. 3. Risk and reward. Growth investing comes with higher risk because these companies are often in the early stages of their growth cycle or operate in rapidly evolving industries. 3. However, the rewards can be substantial if the company grows as expected. 4. Industry focus. Growth stocks are often found in industries like technology, healthcare, or consumer discretionary, where innovation and trends drive expansion. Comparing value investing versus growth investing. Now that we've covered the basics, let's dive deeper into the key differences between value and growth investing. We'll break it down into several categories so you can see how each approach stacks up. 1. Risk tolerance. 1. Value investing. Value investors are typically more conservative. 1. They seek out companies that are already established and have strong fundamentals but may be temporarily overlooked by the market. 1. This approach can mitigate risk because value stocks tend to be less volatile. 2. Growth investing. Growth investors are more risk tolerant. 2. They're betting on companies that have the potential for rapid expansion, but there's no guarantee that growth will materialize. 2. Growth stocks can be more volatile, and their prices are sensitive to changes in market sentiment. 2. Time horizon. 1. Value investing. This strategy requires patience. 1. It can take time for a stock's true value to be recognized by the market, and value investors are often willing to wait years to see returns. 2. Growth investing. Growth investors are also long-term oriented, but they expect to see results more quickly. 2. Growth stocks often deliver returns faster than value stocks if the company's growth accelerates as anticipated. 3. Dividends. 1. Value investing. Value stocks are more likely to pay dividends because they're often mature, well-established companies that generate consistent profits. 2. Growth investing. Growth stocks usually reinvest their earnings into the business to fuel further expansion. 2. As a result, they typically don't pay dividends, and investors rely on capital appreciation for returns. 4. Valuation metrics. 1. Value investing. Value investors rely heavily on valuation metrics like the price-to-earnings ratio, P/E, price-to-book ratio, P/B, and dividend yield. 1. These metrics help them determine if a stock is undervalued relative to its intrinsic value. 2. Growth investing. Growth investors focus more on future potential than current valuations. 2. They're willing to pay a premium for a company that shows the potential for significant growth, so high P/E ratios are common among growth stocks. 5. Sectors and industries. 1. Value investing. Value stocks are often found in industries like utilities, consumer goods, financials, and energy, sectors that are considered more stable but may not experience rapid growth. 2. Growth investing. Growth stocks are more common in technology, healthcare, and consumer discretionary sectors, where innovation and market demand drive growth. Historical performance. Value versus growth. One of the biggest questions investors ask is, which strategy performs better? The answer isn't simple. It depends on the market environment and the time period. 1. Value stocks. Historically, value stocks have outperformed growth stocks over the long term, particularly during economic downturns. 1. This is because value stocks tend to be more stable, with less downside risk. 2. Growth stocks. Growth stocks have outperformed during bull markets, especially in recent years, thanks to the rise of technology and innovation-driven companies. 2. When the economy is booming, growth stocks often see massive gains. However, there have been periods where one strategy has significantly outperformed the other, and understanding when each strategy works best is key to maximizing returns. When should you choose value investing? If you're considering value investing, here are some situations where it might be the right choice for you. 1. You're a long-term investor. Value investing rewards patience. 1. If you're willing to wait for the market to recognize a stock's true worth, value investing might be for you. 2. You're risk-averse. Value stocks tend to be less volatile than growth stocks, making them a safer bet in uncertain markets. 3. You like dividends. Many value stocks pay regular dividends, providing income in addition to potential capital gains. When should you choose growth investing? Growth investing is an attractive option in these scenarios. 1. You're comfortable with risk. Growth investing can deliver substantial rewards, but it comes with higher risk. 1. If you're willing to endure some volatility, this strategy could suit you. 2. You want high returns. Growth stocks have the potential to deliver significant capital appreciation, especially in the right economic conditions. 3. You're focused on innovation. If you're drawn to companies that are at the forefront of technological or industry trends, growth investing offers exciting opportunities. Blending the two strategies, the best of both worlds? Many investors don't choose between value and growth investing, they blend the two. This can create a balanced portfolio that captures both stability and growth potential. Here's how you can combine these strategies. 1. Core and satellite approach. You can use value stocks as the core of your portfolio for stability and dividend income, while growth stocks serve as a satellite to capture high returns during bullish markets. 2. Diversification across sectors. A mix of value and growth stocks across different industries can help you mitigate risk while maximizing returns. 3. Adapting to market cycles. You might lean more heavily on value investing during economic downturns and shift toward growth investing during periods of economic expansion. Conclusion: which strategy is right for you? The choice between value and growth investing ultimately depends on your personal financial goals, risk tolerance, and time horizon. Both strategies have proven successful in different market environments, and the best strategy for you may even be a combination of the two. If you're a more conservative, long-term investor seeking steady returns and income, value investing could be your ideal approach. If you're willing to take on more risk for the potential of higher returns and are excited by innovative, fast-growing companies, then growth investing may be your ticket to success. Whichever path you choose, the key is to stay informed, do your research, and remain disciplined in your investment decisions. Remember, there's no one-size-fits-all answer in investing, but understanding these two powerful strategies will help you make more informed choices on your journey to financial success.